We left off from part one of this problem, sorry, where we just to put in our new cash flows for 4 years of $60,000 a year, right here each year, and we put in a reduction in operating expenses of $6,000 a year right here, and now right here you can see I've actually used the percentages way up here. This is C. This is actually D14. Yeah. See. So I've actually computed down here the depreciation percentages for each year using this a table or a schedule right here. Okay. From the 3-year makers class schedule. So that's actually back in chapter 4, I believe, but I put that in there. So anyway, so that is what we subtract that out because that's going to be like a loss. It's going to be an expense. Then that's going to then our change in operating income right here is just simply going to be the sum of these first three right here. Okay, so as you can see, it's very, very low at the beginning because of our really high new depreciation expense, and then it's going to get, and then as the percentages up here go down, then that's going to make our cash flow or our change in operating income go way up in year 4 here. Okay, now this is our taxes right here. So this is something that we have to, in this case right here, since we have a positive, we're going to have a negative in taxes because we have to pay tax on this in this positive change. Now, when it's a negative right here, because see this percentage in depreciation is so high, 44.5% in year 2, we actually have a negative change in operating income of negative 14,100. So that's going to actually make our give us a tax refund. And then you can see that now then we have our change in earnings after a tax. We're simply here we're subtracting in years 1, 3, and 4, and in years 2 we actually add this in, so our change is actually higher than our change in earnings after taxes here is actually less negative than our change in operating income, and the rest of these it actually gets lower. Our change in earnings after tax is actually lower in years 1, 3, and 4 than our change in operating income because we're actually paying out the taxes on a positive change in operating income. And then at the end here, we have to add back our depreciation as a cash flow, because that's going to give us, in the reason, and I think we learned this in a prior chapter, we add back the depreciation expense as a cash flow because that comes off our taxable income. So that's why it shows up as a positive cash flow, because this is money that we do not have to pay the 40% tax on. And then we end up with, after adding this back here, after adding these two, this cell C, actually we're adding all of these, right? Yeah, we're let's see. Let me just go back here. No, we're not. We're adding these last two here to get our net incremental operating cash flows for each year. Okay. Alrighty, now that's going to take care of that. So we know what our net incremental operating cash flows are going to be as a result of installing this new process line. And it's going to be positive. Okay, so now the last part, or I think it's the last part, almost the last part. So at the end of this new process line's economic life, we're going to sell it for $20,000. So we think about that. It was purchased up here for $180,000, and we're going to end up after 4 years. It's going to have a resale value of only 20,000. So lost a lot of value. Now the cost of the capital for a company is 6%. Now another way you can think about this cost of capital is opportunity cost. In other words, you can think about this as a choice. The company could have either taken their initial capital outflow right up here of $181,048, and they could have invested it and gotten a return of 6%. So the opportunity cost for buying this new process line equipment is 6% that they could have earned somewhere else. So that's one other way you can think of the cost of a capital, or the discount rate. Okay, and we put that in at the very beginning. If you remember way up here. Okay. Alrighty, so we want to calculate now the net present value. So how much value is the company going to gain at the end of 4 years as a result of buying this new equipment? And we want to also calculate the internal rate of return. And since I've got this in the spreadsheet, I've got the formulas in here, we don't have to have a financial calculator. And then we want to, okay, whatever, we're going to round it off, and we're going to recommend whether we should do this project or not. And if you remember, I believe from our last chapter, if we have a positive net present value and the internal rate of return is higher than the discount rate, then we're going to say yes, we should do it. So that's what we're looking for here. So let's go ahead and put in the resale value here, and that's going to give us the income tax on the sale, and our net cash flow of the sale is going to be $12,000. Now here's where we have to actually add back in. We're going to do what's called recover our net working capital investment. So if you remember, when we were way back up here, we had to borrow an additional $7,000 right here in order to make our increase in total liabilities the same as our increase in total assets, because that just has to, that equality right here has to hold. So we said, well, we're probably, let's just assume we borrowed this for our new part of our additional $10,000 right here in inventory, and we need now at the end we're going to sell this back. So say these are we're going to sell this. We're going to at the end of the project, anything that we had to buy in order to make this project work, we're going to sell it, or we're going to, and it's called recovering our net working capital. So that gets added back in. Now, if you want to read about that actually in the book, I actually pulled that up right here. And the example they give in their book is the additional cash that they had to have was $110,000 in net working capital, and at the end they say that it's recaptured, and that is in the form of a positive cash flow. So if you go to the bottom, because this has got a footnote 2, we can read about this. And so this isn't actually clear, but this is what the book has on it. It's not as clear as it probably could be. So footnote 2 says current assets in the amount by which they exceed current liabilities are sold and not replaced because they are no longer needed. So that's why I said that we can maybe assume that these current assets that we're selling here, in order to recover our $7,000 in working capital, could just be our excess inventory. Okay. All right. So let's finish up here. So once we do that, our cash flows are going to be here, and this is the actually total net cash flows in the blue, and this is the net present value of each of the cash flows, as we, because we look at the using the discount rate here of 6% right here. Okay, so this would mean that so if you think about this, the net present value for year 4 is going to be lower because we only, or the present value of cash flows, because if you had this earning 6% for 4 years, it's going to grow more than it's going to grow just for 1 year here. Okay. So now we total all of this up right here. We total this, and we get the total present value of our cash flows here. So this is our total. This is what we say that we actually, our total, what we would have to have in order to have all this money coming in for 4 years. Okay, and then we have to subtract our initial cash outflow right here, which we got way back up here, right there, and that's going to give us our net present value. So our total present value of cash flows minus the initial cash outflow at time 0 is going to give us our net present value, which is positive. And then I put in the formulas here. So here's our net cash flows here, our cash outflow here, and I put the formula right here to give us our internal rate of return, which you can see is well over the discount rate of 6%. And then so I also put in a graph here. You can actually see the so we're right here at 6% right there. So you can actually see the profile of this project here with a different discount rates, just so you could see that. And that's going to fill in. So all you need to do now is just, in this gray box right here at the bottom, you need to answer, this is done for you here. Okay, so you up here, right over here, way over there. Okay, right there. Okay, and then at the bottom here, sorry, let me just jump back down. You need to talk about whether you would recommend accepting this project or not, and why. Looking at the net present value and the internal rate of return. Okay, wow, that's the comprehensive problem for chapter 11. Now you're going to have problems not quite this long, but you're going to have 2 problems very similar to this on your quiz. So make sure you understand what you're doing here, and you should have no problem on the quiz.